Trump's Liberation Day tariff announcements caused mayhem in financial markets, the effects of which are expected to reverberate throughout this upcoming week. But let's also see what's on this upcoming week's calendar that investors should keep an eye on. I'm Christina Marucos. You're watching The Week Ahead here at XM.com. Thanks for joining us. And with me today to unpack this very busy week is our senior market analyst, Haralambos Pissouros. So, Haralambos, let's start with the big theme, let's say. Trump's tariffs, of course, increased worries about a global recession. And although the full effects are still unknown, we did see an immediate reaction in the dollar and stocks, which took a plunge. Now, this indicates that investors are clearly concerned. So is there anything that can improve risk sentiment right now?
Hello, Christina. To be honest, I think there is nothing to improve sentiment right now. The only reason for seeing counter moves, in other words, a rebound in the US dollar and on Wall Street, maybe if market participants believe that they went too far and that the moves after the tariff announcements were overstretched. But in my opinion, sentiment may remain fragile as investors have become even more fearful about the potential recession this year. Just to give an indication, the Atlanta Fed GDP Now model is already projecting a deep contraction for the first quarter of 2025, while JP Morgan said that the probability of a recession has increased to 60% after Trump's announcement. Now, investors' concerns are also reflected in Fed Fund futures, which suggest 100 basis points worth of rate cuts by the Fed this year, which means 4 quarter-point rate cuts, which is double than the Fed's projection of the latest Fed projection of 50 basis points. Now, with China and the EU being quick to respond that if the tariffs indeed take effect, they will retaliate, I believe that the chances of further escalation in this trade war with more tit-for-tat tariffs remains elevated. Therefore, the dollar could continue to slide and the bloodbath in equities could deepen.
Now, let's stay in the United States. You mentioned earlier Fed Fund futures and, of course, Fed rate cut expectations. And that's why we turned the spotlight to the latest CPI report for March. We'll be getting it this upcoming week. We've seen inflation be rather sticky lately. So if this latest report corroborates this theme, how would that affect Fed rate cut bets and, of course, the dollar this upcoming week?
Look, tariffs are not only posing a threat to economic activity, but also presenting an upside risk to inflation. Inflation in the US has been proving more persistent than expected even before tariffs on steel and aluminum were incorporated in the calculation. And we've seen that with the core PCE index for February rising to 2.8% year on year. Now, this further complicates the Fed's work as it may find itself between a rock and a hard place, trying to safeguard economic activity on the one hand and trying to prevent inflation from spiraling out of control on the other. Now, with the prices sub-index of the ISM manufacturing PMI for March climbing to 69.4 from 62.4, I believe that the risks of the CPIs appear to be tilted to the upside. So, further acceleration in inflation may prompt traders to scale back some of their rate cut bets, and the dollar may stage a modest rebound alongside the US Treasury yields. However, higher borrowing costs for longer could risk an even deeper recession down the line. So, with recession fears remaining elevated, any recovery in the US dollar could prove both limited and short-lived.
Now, Haralambos, let's turn to the central bank front. The Reserve Bank of New Zealand meets this upcoming week. It's highly expected to cut rates again. So where would that leave the Kiwi?
With regards to the RBNZ, when they last met, they cut rates by 50 basis points and they projected that rates will be 75 basis points lower by year end. That said, the turbulence around Trump's tariff policies has prompted investors to pencil in an additional 90 basis points worth of rate cuts this year. So, with China, New Zealand's main trading partner. Being Trump's primary focus when it comes to tariffs, it is difficult to envision a scenario where the RBNZ adopts a less dovish tone than it did previously. Market participants are nearly certain about a 25 basis points cut at this gathering, with the probability of a back-to-back quarter point reduction in May standing at 75%. So, taking all this into account and considering the heightened risk that the trade war between the US and China could further escalate if China retaliates, the RBNZ may once again accompany its rate decision with a clear signal of its readiness to continue easing. This would likely encourage Kiwi sellers to extend their short positions.
And finally, Haralambos, is there anything else on the upcoming week's calendar or data releases investors should keep an eye on?
Yes, we have China's CPI and PPI data for March coming out on Thursday. This is where the impact of the March tariffs may be reflected. In the UK, we have the monthly GDP for February. Now, with regards to the Bank of England, although UK data have been relatively supporting the bank's stance of no urgency to cut interest rates aggressively, investors are assigning a strong 85% chance of a 25 basis points rate cut at the next decision. I believe that for that number to be reduced and for the pound to gain further ground, the GDP number may come in on the strong, may need to come in on the strong side.
Haralambos, thanks so much. This was The Week Ahead here at exam.com.